Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most popular and, let's be honest, most misunderstood ways to approach the financial markets: day trading. We'll be breaking down the core principles from Andrew Aziz's foundational book, How to Day Trade for a Living. We'll cover everything from the essential tools and technology you need to the critical importance of risk management, the specific, repeatable strategies that professional traders use, and finally, the psychological fortitude required to actually succeed in this game. Whenever we can, we answer questions in the comments. The world of trading can feel isolating, and sharing your journey, your wins, your losses, and your questions is incredibly valuable. So please, feel free to comment below with your thoughts and experiences. You'll not only help yourself, but also contribute to a community where we can all learn from one another. So, what exactly is day trading? Let's clear the air right away. It is not a get-rich-quick scheme. It's not gambling, and it's not about mindlessly clicking buttons based on a hot tip you saw online. Andrew Aziz presents day trading as a serious profession, a business. Think of it less like buying a lottery ticket and more like becoming a specialist surgeon. It requires immense preparation, a deep understanding of your craft, a disciplined routine, and the right set of tools. It's a performance-based skill, and just like any high-level skill, it takes time, practice, and a whole lot of dedication to master. Before you can even think about making a trade, you need to set up your workshop. Your trading station is your cockpit, and you can't fly a sophisticated jet with the dashboard of a go-kart. First, you need reliable hardware. We're talking about a powerful computer that won't freeze at a critical moment, and ideally, multiple monitors. Why multiple monitors? Imagine trying to cook a complex meal on a single, tiny hot plate. It's chaotic. One monitor might be for your charting software, another for your trading platform, and a third for news feeds and your stock scanner. It's about having all the necessary information visible at a glance, allowing you to make quick, informed decisions. Next up is your software, and this is where it gets more specific. For serious day trading, a standard retail brokerage app on your phone just won't cut it. Aziz strongly advocates for a direct access broker, or DAS. So what's the difference? A regular broker is like sending a letter through the postal service. You send your order, it goes through their system, and eventually it gets executed. A direct access broker, on the other hand, is like having a direct, high-speed fiber optic line to the stock exchange itself. It gives you incredible speed and control, allowing you to route your orders exactly where you want them to go to get the best possible price. This speed is measured in milliseconds, and in day trading, milliseconds matter. Alongside your broker, you need a powerful charting software and what's known as a Level 2 data feed. Now, this might sound technical, but the concept is actually quite simple. Level 1 data is what most people see. It's the current bid and ask price for a stock. It's like looking at the price tag on an item in a store. Level 2 data, however, is like being allowed into the store's back room and seeing the entire order book. You can see all the different buy and sell orders, who is placing them, how many shares they want, and at what specific prices. It gives you a transparent view of the real-time supply and demand for a stock, which is an enormous edge. Now, before we even whisper the word strategy, we have to build the foundation. And the absolute non-negotiable cornerstone of that foundation is risk management. This is the part most beginners ignore, and it's precisely why they fail. Andrew Aziz is relentless on this point. You must learn to protect your capital above all else. Your primary job as a trader is not to make money. It's to manage risk. The profits are a byproduct of excellent risk management. The most important rule he champions is the 1% rule. It's simple. You should never, ever risk more than 1% of your total trading account on a single trade. Let's make this concrete. Suppose you have a trading account with $30,000. 1% of that is $300. This $300 is the absolute maximum you are allowed to lose on any one trade. This does not mean you can only buy $300 worth of stock. It's about the potential loss. This single rule acts as your financial survival mechanism. It ensures that even if you have a string of 5 or 6 losing trades in a row, which will happen, you're still in the game. You haven't blown up your account and can come back to trade another day. A trader without capital is like a carpenter without wood. So how do you apply this 1% rule in practice? It comes down to something called position sizing. This is where the rubber meets the road. Let's say you've identified a stock you want to trade. It's currently trading at $25. Based on your analysis, you decide to enter the trade at $25, and you place your stop loss at $24.50. A stop loss is a preset order that automatically sells your position if the price drops to a certain level, protecting you from further losses. In this case, your risk per share is 50 cents. Your total allowed risk based on your $30,000 account is $300. To figure out how many shares you can buy, you simply divide your total allowed risk by your risk per share. So, $300 divided by 50 cents gives you 600. This means you can buy 600 shares of this stock. If the trade works, fantastic. If it goes against you and hits your stop loss at $24.50, your loss will be contained to exactly $300, or 1% of your account. Mastering this calculation before every single trade is what separates professionals from amateurs. It removes emotion and replaces it with a strict mathematical framework for survival. All right, with our risk management seatbelt firmly buckled, we can start talking about how to actually find and execute trades. The first step is to focus on what Aziz calls stocks in play. You can't just trade any of the thousands of stocks out there. That's like trying to find a needle in a continent-sized haystack. Stocks in play are stocks that have a reason to move. They have a catalyst, like a major news announcement, an earnings report that surprised Wall Street, or a new product launch. This catalyst generates unusually high trading volume and significant price movement, or volatility. You go where the action is. It's like being a storm chaser. You don't sit around on a calm, sunny day. You look for the storm fronts where the energy is. Once you have a list of stocks in play for the day, you start looking for specific, repeatable patterns. These patterns are your bread and butter. Aziz focuses on a few high-probability setups. One of the most famous is the ABCD pattern. This is a classic bullish pattern that signals a potential continuation of an upward move. It sounds a bit like alphabet soup, but it's a visual story of a stock's momentum. Let's break down the ABCD pattern. Point A is the initial sharp spike in price. This is usually the first big move of the day, happening on very high volume, as news hits the market and algorithms kick in. It's a sudden, aggressive burst upwards. Point B is the peak of that initial spike. This is where the first wave of buyers starts to take their profits, and the stock begins to pull back. It's a natural breathing point for the stock. Then comes point C, which is the most critical phase for a trader. This is a period of consolidation. The stock stops falling and starts to trade sideways, forming a new, higher support level. The price bounces around in a relatively tight range, and importantly, the volume usually dries up. This is a sign that the sellers are losing steam and the stock is gathering energy for its next move. This is your waiting period. You watch it like a hawk, but you don't do anything yet. Finally, we have point D. This is the breakout. The stock price breaks above the high of point B, and ideally, this breakout happens on a surge of new volume. This is your signal to enter the trade. You go long, buying the stock. With your stop loss placed just below the consolidation level of point C. The logic is that the stock has proven its strength by holding a higher low and is now ready to continue its upward journey. It's a beautiful, logical progression of market psychology captured in a simple chart pattern. Another powerful strategy Aziz details is the bull flag pattern. The name is very descriptive because the pattern genuinely looks like a flag on a flagpole. The pole is a strong, sharp, almost vertical run-up in the stock's price. It's a clear display of aggressive buying pressure. Following this pole, the stock enters a consolidation phase, which forms the flag. This flag is typically a rectangular or slightly downward sloping channel where the price pulls back gently on much lower volume. Think of it like a sprinter who just ran 80 meters of a 100-meter dash. They take a quick moment, a couple of breaths, before the final burst of energy to the finish line. That's what the flag represents, a brief pause before the potential continuation of the trend. The trade setup is to watch for the price to break out above the top trend line of the flag consolidation. When it does, you enter the trade, expecting the stock to make another move up that is often proportional to the length of the original flagpole. Of course, there's a bear flag too, which is just the inverse pattern used for shorting a stock that's in a downtrend. A third fundamental strategy, especially popular for the market open, is the opening range breakout, or ORB. The first few minutes of the trading day, from 9:30 a.m. Eastern Time, are often the most volatile. A ton of orders that have built up overnight are executed, and prices can move very quickly. The ORB strategy aims to capitalize on this initial momentum. A trader defines an opening range. This could be the high and the low of the first minute, the first 5 minutes, or even the first 15 minutes of trading. Let's say you use a 5-minute opening range. You wait for the first 5-minute candle to close at 9:35 a.m. You mark the high price and the low price of that candle. Your trade is then simple. If the stock price breaks above the high of that range, you go long, betting that the momentum will continue upwards. If it breaks below the low of the range, you go short, betting the momentum is to the downside. It's a pure momentum play, but you must be nimble, as these moves can be fast and reverse just as quickly. Your stop loss is typically placed on the opposite side of the range. Now, I can explain these strategies all day long. You can memorize them, draw them out, and understand the logic perfectly. But none of it will matter if you can't master the single most challenging aspect of trading, your own psychology. Andrew Aziz dedicates a huge portion of his book to this, and for good reason. The market is a battlefield, and the two biggest enemies you will face are not other traders or complex algorithms. They are the fear and greed living inside your own head. Let's talk about fear. Fear manifests in several ways. There's the fear of missing out, or FOMO. You see a stock rocketing up without you, and you jump in late, right at the top, just before it reverses. You abandoned your plan because you were afraid of missing the move. Then there's the fear of being wrong. This causes you to hesitate on a perfect A+ setup. You see the pattern, everything lines up, but you freeze and the trade takes off without you. And perhaps worst of all, there's the fear of losing, which can cause you to exit a winning trade far too early, grabbing a tiny profit when your plan called for a much larger one. On the other side of the coin is greed. Greed is what makes you violate your 1% risk rule. You have a good feeling about a trade, so you decide to risk 5 or 10% of your account, thinking this is the one. One bad trade can then cripple your account. Greed is also what turns a winning trade into a losing one. The stock hits your profit target, but you think, I'll just hold on for a little more. The stock then reverses, blows past your entry point, and you end up taking a loss on a trade that was a beautiful winner just moments before. So how do you combat these powerful emotions? The answer is twofold: discipline and patience. Your trading plan, with its strict entry, exit, and risk management rules, is your shield against emotion. Discipline is the strength to hold that shield and follow your plan to the letter, no matter how scared or greedy you feel. It's about turning your trading into a systematic, almost boring routine. Process of execution. You see your setup, you check your risk, you place the trade. If it works, you follow your exit plan. If it doesn't, your stop loss takes you out. There's no room for improvisation or gut feelings. Patience is the other side of that discipline. It's the ability to sit on your hands and do nothing when there are no high-quality setups. The market doesn't offer perfect opportunities every single minute of every single day. A professional trader might only take 1 or 2 trades a day, or even no trades at all if the conditions aren't right. Amateurs feel like they need to be constantly busy, constantly in a trade. This leads to forcing low-probability setups and slowly bleeding their account dry. A professional poker player folds most of their hands. They wait for a strong starting hand and the right situation to bet. A professional trader does the same. To aid in this psychological battle, Aziz stresses the importance of keeping a detailed trading journal. This is your personal feedback loop. It's not just a log of your profits and losses. For every single trade, you should record the date, the stock symbol, the strategy used, your entry price, and your exit price. But you also need to record the why. Why did you enter this trade? What was your thesis? Take a screenshot of the chart at the time of entry. Then record why you exited. Did you follow your plan? Did you exit early out of fear? And most importantly, record your emotional state during the trade. Were you anxious? Overconfident? This journal, when reviewed regularly, will reveal your weaknesses and your strengths. It's the single best tool for self-improvement. So what does a day in the life of a disciplined trader following this model actually look like? It certainly doesn't start at 9:29 a.m. The real work begins hours before the market opens. This is the pre-market preparation phase. You're using your stock scanning software to find those stocks in play we talked about. You're looking for stocks with a catalyst, high pre-market volume, and a significant price gap up or down from the previous day's close. You're building a watch list of no more than a handful of top contenders for the day. You read the news associated with each one to understand the story behind the move. You're mapping out potential support and resistance levels and identifying which strategies might apply if certain patterns form. By the time the opening bell rings, you should have a clear, written plan for the stocks on your list. Then comes the trading session itself. The first 2 hours, from 9:30 to 11:30 a.m., are often called the golden hours. This is when volatility and volume are at their highest, and the best trading opportunities often present themselves. This is when you are most focused, executing your plan. After that, the market often enters the midday doldrums. Volume dries up, price action becomes choppy and unpredictable. For many traders, This is the time to step away from the screen, take a break, have lunch, and clear your head. You can come back for the final hour of trading from 3 to 4 p.m. when volume often picks up again as institutions close out their positions for the day. But the day isn't over when the market closes. The post-market review is just as crucial as the pre-market prep. This is when you open up your trading journal and analyze the day's performance. You go over every trade, win or lose. You look at what you did right, and more importantly, what you did wrong. Did you follow your plan? Did you chase a trade? Did you miss an opportunity? This process of self-evaluation is where the real learning and growth occur. It's what separates the trader who lasts 3 months from the trader who can do this for a living for 10 years. Now, it's time for a very important reality check. All of this sounds great in theory, but putting it into practice is incredibly difficult. Andrew Aziz himself admits that he blew up several trading accounts when he was starting out. Success is not guaranteed. There are also significant costs to consider. Professional-grade software, data feeds, and commissions are your business overhead. They can run into hundreds of dollars per month. You need to be profitable enough just to cover your costs before you can even think about paying your bills. Furthermore, in the United States, there is a regulation known as the Pattern Day Trader, or PDT Rule. This rule states that if you make 4 or more day trades, which is buying and selling the same security on the same day, within a 5 business day period, in a margin account, you must maintain a minimum account balance of $25,000. If your account drops below that level, your day trading privileges are suspended. This rule was put in place to protect new traders from the risks of overtrading with insufficient capital. It's a significant barrier to entry for many. So what's the solution if you don't have $25,000? Or if you're not yet ready to risk real money? The answer is the simulator. Every single good trading platform offers a paper trading or simulator mode. This allows you to trade with fake money in a real-time market environment. This is your flight simulator. You would never let a pilot fly a real Boeing 747 with 300 passengers without them having spent hundreds of hours in a simulator first. Trading is no different. You should trade in a simulator for at least 3 to 6 months, practicing your strategies, managing your risk, and keeping a journal, until you can prove to yourself that you can be consistently profitable on paper. If you can't make money with fake money, you have absolutely no business trying to trade with real money. In the end, the path to day trading for a living, as laid out by Andrew Aziz, is not a secret formula, but a blueprint for building a professional enterprise. It rests on several key pillars: treating it as a serious business, not a hobby; implementing ironclad risk management to protect your capital at all costs; mastering a small number of high-probability strategies until they become second nature; and developing the unwavering discipline and patience to execute your plan flawlessly, day in and day out, while keeping your emotions in check. It's a marathon of consistency, not a sprint for a single jackpot. It's about building a skill that, if nurtured correctly, can provide a unique form of financial freedom. But like any profession worth having, it demands a high price in dedication, learning, and resilience.